Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, November 14th, 2018. Pretty much more of the same today as far as the bigger picture goes, meaning that we closed down red. Now, there are some developments on the intraday charts we'll get to in a second. The markets did have a chance to push it green, started to have an intraday rally, but again, like we've seen lately, more of the same, where the sellers just stepped out of the woodwork and met that rally with more selling and knocked the markets back down to close pretty decent in the red today. This is SPY up or down 0.68% today, and we'll get to the intraday charts and some developments there in a second. Keep this video rather brief, but you can see so far we're playing out in typical form of a correction. Initial wave down. We've had a couple kickback rallies along the way, but as I've highlighted, this is a pretty big level here. That 280-ish level, that's where that previous rally failed, and this one as well. And there's that potential IHS that I've already shared my thoughts on, inverse head and shoulders. Again, not that it can't play out for what it is, but head and shoulders, inverse head and shoulders is a bottoming pattern that comes at the end of an extended downtrend, not an extended uptrend. So if it were to play out, it would be more of a continuation type pattern. So we'll see. Now, as far as levels go, and that's really what we have to look at here, 268.59, that support here on the daily chart. You can see we had the big gap right here. Uh, that gap there, so we pretty much backfilled or came close to it, reversed a little shy, and give or take on that level there, add a few, a dime or a few nickels either way in either direction, and you can see some support levels and gaps along the way. So it's a pretty decent support level. It was sliced through on the first sell-off, and I think if it gets taken out soon here, which right now you have to go with the status quo, which is the fact that the market is in a downtrend, that this so far was only a counter trend snapback rally that has failed and has been met with selling each and every day. You can see we had another 2 days there, a little small candle the second day to try to give it another run at that 280.81, those previous highs. And so far, nothing but red candles there. So, recognize the trend for what it is. I'll point out some potential bullish developments on the intraday charts, and they still could play out. They just tried to today, but again, that was shot down. But looking at everything else, a bigger picture, the price action, the posture of the indicators, you can see the PPO down here, which I'll often use as a trend indicator, giving the last of the two lines, which is in this case the EMA, the 9 EMA, or the signal line. That's the white line there. And when it's above the zero line, as it was all this time, the trend is bullish. And when it crosses below, the trend is bearish. And as you can see there, so bullish and bearish here, and we're still deeply in bearish territory, well below the zero line. And to add to that, the PPO line, the top line, the blue one, is curling down, it's pointing down. So as of now, bigger picture, and again, I get to the near-term stuff for more active traders, but bigger picture, I don't see anything that has changed my outlook. My preferred scenario, which still has us going down to either test or quite possibly undercut these lows, come somewhere in here. I'm talking the lows from earlier in the year and that previous reaction low that we had on October 29th, and then maybe these here you have these two lows here, significant lows from earlier in the year, those first two drops that we had in early 2018. And if so, that would look something like this. I've laid out the scenario where it would be nice to see if we get this. It would set the stage for some nice long side swing trades. Come on down, prices fall down from where they are now. We continue to sell off and undercut. Maybe come in, match those lows, but it'd be nice to see them slice through that October 29th low. We could certainly come in at lower levels. That'll be determined. We'll watch the tape. We'll watch the market action. We'll look for signs of any type of reversal, bullish candlestick patterns, divergences, selling climaxes, other things like that. And if so, if we get it, you'll have nice bullish divergence here on the daily time frame. And those are when I really like to position for swing trades and major trend changes, just like we had a divergent high right there that led to so far the correction that we're in now. So that remains my primary scenario, but there's levels to watch. So watch for today's lows. I'll get to the intraday charts in a second. That'll show you some other levels. QQQ, more of the same as well, down 0.76% today. A lot of that has to do with Apple is finally playing a game of catch up. Apple, as I mentioned a few weeks back, was one of the last holdouts of the FANG stocks. I like to use the term FAAMG, more representative of the heavy top holdings in the NASDAQ 100 because NASDAQ is sort of down their way. I'm sorry, NASDAQ, Netflix is sort of down their ways. But with that being said, we're continuing to see what's been referred to as the defanging process. So a member in the trading room said that the market continues to get defanged, F-A-N-G, and that seems to be the case. So you're seeing bottom line pressure. Apple was down. I'm just looking to the left of the screen, 2.82%. Microsoft down 1.84%. Amazon almost 2%. Alphabet was green today, so was Facebook. But again, I just read those down in order descending market cap. So Apple being the heaviest component, and then Microsoft and Amazon, those are overpowered any gains that we had today in Alphabet and Facebook. So that's like I said, just nothing but selling since we've come up and backtest that trend line there. You can see we hit it. There's a trend line right there, and I don't see anything in the charts. We look at the PPO. I'm seeing the PPO line coming down quickly. Remember, that's a trend indicator, and it's pointing lower, and it's poised to make a bearish crossover right now. On any more downside, it hasn't made it yet. So this bullish crossover here in the rally and the bullish divergence so far, that was just a whipsaw signal, a false signal. A lot of bulls, so some traders will go long on bullish crossovers. They do a pretty decent job of indicating trend changes, especially when they come high and low. And like again, we had a rally out of it, and it was a decent rally in percentage terms. And that's what I want to say. It certainly it's not as if these divergences in that bullish crossover didn't play out. But it was such a sharp rally. It was almost a 10% gain, and that's certainly enough to satisfy that. So now, as we can see, a good part of that gain has already been faded, and there's not a lot I see in the charts here that tell me that this rally's over. Let's take a look at the 60-minute charts. Here's a couple charts I pointed out on the right side of the chart. I posted these on the homepage. It was public content. It was this morning before the market opened. And it was the NQ, which are the NASDAQ 100 E-mini futures, and ES, I'll show you in a second. At the time they were, I can't remember, I think they were up higher. They were here, and I pointed out these potential bearish falling wedge pattern. I'm sorry, bullish falling wedge patterns. That's when you have a trend line like this. Here's a wedge, it takes this wedge shape, and it's confirmed with bullish divergence. So what happened is we had a run at the top, and I made mention, watch, break out above the wedge could trigger a rally, but we could also go down, and you might be able to position long on the bottom. And this is more active trader stuff. Now, if these divergences on the 60-minute chart play out, it could morph into more. So swing traders should take note. And in fact, somebody asked me after I posted, I saw a comment in the trading room today, Randy, these divergences are confusing me. What to do? My answer is this: as a swing trader, looking at the daily charts and the price action, nothing there has changed. As a more active trader, if you're in and out of positions, like I am very often when there's a lot of volatility, I'll be long NQ 1 minute, short the next, and sometimes 5-6 times a day in and out of that when there's periods of high volatility, and you can make those trades. But long-term swing traders, if anybody positions short right now on the move down, we still have that QQQ active short and some other active short trades on the site. There's no reason, I don't see any reason at this point to, modify the trading plan or close those out early. However, with that being said, let's watch and see what happens tomorrow. I want to point out that although these divergences haven't played out yet, two things. And this is also what I said to that. The primary trend right now, or at least the near-term trend, is bearish. Therefore, this market is on, and today showed us that it's in a sell the rips mode. Back in 2017, even after the first correction this year, while we had a rally, here, let's go back. Here's a market in buy the dip mode. This one, buy the dip works. And when the trend changes, these were quick corrections. And if you bought the dip, it actually, well, it depends where you got it here, paid off. But so far, buying the dip has not worked. In fact, it's caused a lot of pain. If you bought the dips, I mean, think about it. The dips were and certainly bought all the way down here. Nobody, I shouldn't say nobody. We saw this one coming, but for those that are have been buying the dip for years and swear by that mantra, they got burned all the way down. They finally caught one. They had a runner trade. Probably thought we were going back to new highs like every other time that happened. Didn't happen. So again, they probably bought the dips here. Here was another dip buying opportunity that maybe, hey, the correction's over. Kramer said buy, but wrong. What happened? It was just another counter trend bounce. So what I'm getting at here is this is a pattern, and you have to recognize the pattern that dip buying is not working. What is working and has been, and until we see enough evidence in the chart that tells us otherwise, sell the rips. Sell the rips. That's what's been working lately, and today, especially when we go to here, I'll show you what I'm talking about on an intraday chart. Here's QQQ on the 1 minute chart. This would be our open right here. Let me show you what I'm looking at. Here's the 4 p.m. yesterday's close. So there's our open. We gapped up. They sold it down, took it down pretty good, faded that, and then you can see that late day rally where those divergences started to play out. But what happened is, as soon as they turned it green, the seller stepped in pretty aggressively too. This is, there was certainly the potential in the charts for them to take that and run, but no, they faded almost all of that late day rally to close the market not too far off today's lows. And again, at the end of the day, what's most important is what did the market do, not just intraday, but how did it close the day? And we closed yet another red day down 0.76% in QQQ. And again, SPY was down pretty good as well today. Okay, so back to that, and what I was saying about these divergences is just like in a strong uptrend, when you have a correction and you have, or I should say, I'm sorry, during a rip to an uptrend and you have negative divergences or bearish chart patterns, how they tend to fail or not play out, or in other words, maybe those divergences just keep getting burned through, or they do play out. Maybe you get a bearish rising wedge pattern in a strong uptrend and it breaks down, and just as it looks like the market's starting to go down, your shorts are profitable, boom, they gun it, they reverse it, the dip buyers step in, and they run the market up to new highs and follow that pattern. That may be in play here too, so I want to point that out. But I wouldn't point these out if they weren't worth mentioning. I mean, my job, again, is it's not to tell anyone what to do, what to buy or sell. It's to point out what I see, my analysis, and then you can decide how to trade that. Now, with these wedges here, again, a break of the downtrend line would certainly be a potential buy signal, and I don't see why it wouldn't. And you also have this 6907-ish resistance there as well. So watch that level. If we do happen to get some buying tomorrow or sometime this week, you have intersecting resistance right there, and that's what I pointed out this morning. And as far as this wedge goes, well, one of two things are going to happen. It'll play out, meaning we'll go move up, break out, and rally. You can see the target. This would be about a measured target right there, ideally, and it might be an objective place to short 70, 60, because the measured target again for a wedge is, and it doesn't have to play out exactly this way. You take the widest part of the wedge, add that to where the wedge breaks out. It's a very simple but pretty accurate measuring tool to gauge how far we could go. So. And now, if it does break out, it depends where we break out. And here's the other thing. So the wedge will either play out or not. By or not, it means we just continue to go lower, and this line moves down, 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 and finally to the point where we don't have any more divergences, and then you don't have a wedge. And so I want to draw that here. So we'll just keep an eye on this. You can see there's pretty strong potential divergences, but now the PPO is pointing lower. And let's say it takes another day or so, there's still the possibility we work our way down within these patterns, something like this, zigzag down, and then go on to breakout. If we do, at that point, this level will be pretty good run to get up there. It's that 6907 level. Again, we were pretty close. We came close to it today, popped above it briefly. And so again, something to monitor. But as I said before, bigger picture, the closer we get to that October 29 low, that's the recent reaction low, off the big drop in October. That's where the market's bottomed. The closer we get to there, there's just very little support, and we're probably going to get more and more panic selling as we start to approach that level. More and more longs that bought in here when they thought the worst was over. They've been just getting, hammered here. They saw their profits evaporate, and then they started going from green to flat, now probably to red. And so these are the folks that will probably dump the closer we get here, and then we could start to see really some waterfall type selling, get a big thrust down, and maybe go on to hit my targets. And if it happens, I think it'll happen soon, probably in the next week or two. If not, these divergences play out. Maybe we still get down there eventually, but we walk back up first. Maybe we grind around for a while. There's a myriad of possibilities. I'm just throwing out there what's going on in the charts. And like I said, my intermediate term outlook, my downside targets haven't changed yet. And this has the potential. And let's look at ES as well. These have the potential to change that. Here's the downtrend line on ES. ES are your S&P 500 E-mini futures. Something else I noted when that individual asked me about the divergences. Number one is that I see them here on the futures, but I don't see them on the indexes. In other words, SPY and QQQ, we don't have comparable divergences. I like to look at the futures because it can sometimes give me a heads up because you have round the clock trading, so you have a lot more reactions. Sometimes you can pick up these divergences that you don't make out on the SPY and QQQ that are only showing the 9:30 to 4 p.m. trades. Here's SPY, or ES, I'm sorry. ES is at pretty significant support. And I don't want to call it the last straw support because again, that would technically be the October 29th lows, but it's the last really significant well-defined support level. And we closed right about on it today. You can see I have that number about 26.96 right there. And we close, or no, that's not closed. Futures trading around the clock. These trade after the market closed today. So we're right there right now, about 2,700. So holding support with potential divergences, bullish divergences in place or positive divergences. And if these divergences are foiled tomorrow um, or sometime this week, by foiled, I mean we just drop down and all of a sudden the PPO and the RSI lines go down below those previous reaction lows because that's what makes divergence. When you have prices making lower lows and the indicators making higher lows. But if and when you take out those previous lows, no more divergence. And you'll probably again start seeing that impulsive selling. So those are some of the things I'm watching. We'll continue to monitor those into trading tomorrow. Let's just take a look at how the charts look on the 60-minute. For I know the majority of traders out there use QQQ or SPY in lieu of futures, so the levels I'm watching there and was throughout the day. I posted a few charts on the right side of the chart on this in the trading room and the front page. 166, we'll call it. I had 166.02. Let's move that down. Just make a nice round number since it's so close. And that's that big gap right there. So again, we bottomed on the 29th right here where the crosshairs are. You can make the candle out. It runs right into the volume candle there. Hold on, let me fix that. Okay, there we go. Made the volume bars gray. So there's the recent low. There's a gap that happened after that, and that started charging the bulls and probably brought some money in. And of course, we had another gap there. So it's technically significant, like most gaps are. And you can see QQQ as I zoom in here on this 60-minute chart. QQQ had been respecting that gap on many. These are 60-minute candles. Look how many reactions we had on there. Finally today, it gave it up, tried, and it looked like it might get it. Again, I said that intraday we had a chance there. Tried to get back above that level, which would have been pretty bullish. It would have been a potential bear trap or false breakdown. But at that last 60-minute candle, you can see the sellers just stepped in and knocked it down. So that put QQQ back down in a pretty precarious technical posture. There's some divergence here on the RSI, and you can barely make it out. It's barely perceptible, a little bit of divergence there on the PPO, but not the clean type of divergence I like to see. Clean separation between the lines. But something worth monitoring. And if we go back down, you can see I have a support level there about 162.20, and there's the candlestick or the low back there was about 160. I don't see a lot of hope in here, but again, I'm very adaptable and open to anything, and I can certainly know a lot of stocks are getting quite oversold. So we can have a snapback rally at any point in time. We just have to be on guard for it. So these levels and developments will help us sniff that out, hopefully. All right, SPY. There's on the 60-minute chart here. Here's a level I was watching today and posting in the trading room and on the site, 269.55. You can see we dipped below it briefly, dip below it again. Here's that candlestick. You can see the candlestick tail there, that little shadow, and then close back above it. So SPY managed to hold on to that. And what that level was, it wasn't technically the top of the gap, but it was a reaction that occurred right after the gap. I'm referring to this big gap back here on the 30th, I think it was, between the market opened on the 31st, gapped up. So if we fill the bottom of the gap, you can probably make it. It's just below 268.12. I'll turn that up for you so you can see that one. And again, we don't have, you can look at the SPY, we do not have the bullish divergence in place right now. So far it's more of the same. And again, SPY, although it made a pretty valiant effort midday to try to get up there and try to get back into the green, it looks like it pushed flat or popped green for a second and then shot down again. So we'll just see how this continues. But as of now, um, the trend and more so the price action, it remains bearish. Just any type of rallies getting sold into. And then finally, maybe we'll wrap it up here with Apple. Apple, this is also typical bear market type action. I pointed this out in the trading room the other day and again this morning that Apple had bullish divergence here. It had it yesterday on the 60-minute chart. These lines are up here. And again, this was when I first highlighted it yesterday, and this line was up here. But what happened is, so I said, look, there's a potential there. If Apple can reverse, confirm these divergences, we can get a rally up to about 202.23, backfill this gap right here. But what happened is Apple just keeps bleeding lower. They cannot catch a bid. We have barely, clinging on, holding on by the skin of its teeth. Some potential divergence there, really flatline divergence, about equal lows on the PPO with prices making a lower low, but they've already burned through the divergence on the RSI. And I know a lot of people own this stock, so I'm going to point out a couple levels to watch. Where I think it's going to go now, before all said and done, is down here at about the 181, 70-ish level. Hit that level, bounce to close the week, maybe back above it, unless, please realize this, that it's the top component of the S&P 500 and the NASDAQ 100. So if we get that other scenario, we start to see waterfall sell-off. I doubt Apple's going to be able to bounce and close back above that level. But it's already lost. Let's look at a weekly chart. Anyways, that's decent support. It's already lost the 200-day moving average, which is a pretty key level in Apple. Here is a cleaner chart. Here's a trend line. This is our bull market trend line. This is the 2000. These are the 2009 lows right here in Apple. So here's the entire bull market that ended the bear market right there. And you can see it's a well-defined trend line. Let's get rid of that fib right there. Well-defined trend line, and we are pretty much on it now. I need to clean that up a little here. Let's pull that in. I want to capture these candles right there. There it is. Let's go back to a weekly chart. So this is worth noting that Apple has not visited this long-term bull market uptrend line in a while, and it's on it right now. Usually you don't see a stock come this far down from being so far above a trend line, just go on and break through it as if it's not even there. It is possible, especially when the right market conditions. But this may be a saving grace for the market. What I say is usually when a stock or an index hasn't visited a very important trend line in a long time, it's been trading above it, usually on the initial tag you get a bounce. You can see we had a couple bounces here. And this is really, I have to be honest, there was a reaction back there in 2009, but this is really where that trend line picks up at. So let me give you a clean board and draw it this way. Let's forget about the 2009 low. Let's draw it like this. And then you can see the reactions here. And so let's try to, sometimes you have to tune these lines a bit to get them to fit. All these candles, you want the bodies and or the wicks touching. And so that's it. So we're now right on a pretty significant trendline support after a pretty strong drop to get there. Again, it doesn't mean we can't go through there. And the other thing is we came in, and I've mentioned in the past many times, this 40-week exponential moving average has always done a great job on Apple and a lot of other stocks defining uptrends, bull and bear markets on a weekly time frame. It's the same as a 200-day. You can see there support. It happened here, support. And then once you break below it, it's resistance. Once the trend returns bullish, it acts as support. And sometimes you'll break it briefly, but you'll snap back up there. You can see so far that's where we bounced. We're pretty far below it now, about as far as we got below it back there in the on early February. So if Apple is going to hold these levels, it needs to hold here soon. And so this is something that has given me pause really on that downside scenario I have of looking for another 5+% to the downside. Is that here's the top weighted component of the SPY and the Nasdaq 100, and I can tell you right now that at this point I wouldn't short it because you have it at pretty long-term support. And yes, it's below that 200-day and 40-week moving average, but not by a whole lot. Bigger picture, I think it goes lower. Let's not. I don't want to be confusing here. I'm looking at these divergent highs that have led to these are the big drops. That's a 40+% correction there off that divergent high. This one was 36 or so. I'm just rough estimating those pullbacks. So there's a lot more to go. This was a big divergent high. And would I be shocked or surprised if we continued down through this long-term trend line and went all the way down here? Because this is where I think Apple is going before all said and done, about 160, maybe even more than that in longer term. But no, I would not be surprised. So I'm just watching this right now. Like I said, on that 60-minute chart, it's clinging on, holding that support level. So if the markets can hold up relatively well this week, even if we get a little more downside, look for Apple. Just watch what happens here if it gets down to about that 181.71 level. It's pretty decent support on the daily chart, and maybe it can mount a late week rally by Friday. Well, tomorrow's Thursday, so we've got 2 days to do it to close back on or above this trend line and possibly even that 40-week. And if not, if you start to see the waterfall sell off, if Apple just slices right through there, remember a hallmark of a bear market is support levels will get sliced through like they're not even there. So just because we're at support doesn't mean we must bounce, but I need to point that out. And Apple's still a great company, beloved stock, but that's not what it's about right now, guys. Fundamentals do not matter here. The whole theme, at least what in my belief, is the unwinding of the margin bubble, unwinding of the credit bubble. It is about hedge funds and institutional funds that run balance funds like pension plans that are having to unwind their risk in the market, and that risk is because they're top heavy in these FANG stocks, Apple, Amazon, Microsoft, and they're not seeing the other cylinders on their portfolio fire, like gold and treasury bonds and things that usually are safe haven assets. So we'll wrap it up here. Those are levels to watch, and hopefully I didn't, lay out a confusing scenario. I made it clear that as of now, the status quo remains down, remains bullish. I pointed out some support levels and potentially bullish developments that could come into play, but if we get more of the same here, they may not. Those divergences on the 60-minute charts of the futures may just dissipate. Apple may break support. And when I look at the chart of QQQ, I cannot make a decent case of going long here at this point in time. Everything I look at the chart, if you didn't tell me the symbol, I didn't know what I was looking at, and you showed me this chart, I would say, and told me it was a stock, I'd say this stock has more downside to go. And so I'm going to stick with that. And, somewhere here, that 154-ish area. And that would give us about another, what is that? Another 6% or so on the QQQ. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.